let's bring in Michael Nathanson of MoffettNathanson. I mean, I'm going to start here with this news, Michael, and that is the fact that you do see these media companies teaming up. A lot more questions than answers right now, but how does it speak to the current media landscape and how much deal making in many different forms we could potentially see this year?
Yeah, we've been waiting forever for someone to do this because half the media world are keeping their rights of sports in the bundle, and two companies, Paramount and Comcast, your parent company, are taking their rights and leaking it over the top. So we've been saying forever that the bundle is really about sports. And the more people who take their rights and leak it over the top, the weaker the bundle gets. So to me, this is a natural outcome. It's smart for the three companies that have not been cheating the system to create a more sports-driven package for sports fans. And again, it's been a long time. We've been thinking about this for a long time. This makes perfect sense. The devil will be in the details, but this is what has to happen in order for a new bundle to be formed.
And I just want to note, maybe we can put up a chart of Fubo TV. That stock is down a little more than 6% after hours. It was the first name focused on this area that I thought about. I don't know, Michael, if you have any thoughts about the impact on some of those smaller players trying to distribute sports content through streaming.
Yeah, we don't cover Fubo, but here's our view. What sports fans want is one place to get all their content. If Disney, Warner's, and Turner gets it, Disney, Warner's, and Fox get together, there's enough content there, and then you can go a la carte with Peacock or Paramount and create a much cheaper bundle of all the sports. So I think it brings deflation to the pay TV world. And again, sports drives the bundle. And I think what these three companies are doing is saying, look, we've had enough of all these rights leaking. Consumers, if you want to basically find a place for sports, we can serve you. And then you can add on different channels and packages a la carte. And we want Hulu Live to do the same thing, and even YouTube TV to start looking at their bundles and really, slimming them down to focus on exclusive sports inside the bundle.
Okay, I got two more questions to get to with you, so let's see how quickly we can do this. But when I look at this chart of these names that are involved in this news today, there's only one that is lower on this news, and that's Disney. We get those earnings tomorrow. Obviously, activist and investor pressure coming from all sides for the name. The fact that it's trading lower tells us what? And what does it say, I guess, specifically about the leverage and the future of ESPN at a time where there is this outside pressure on the company?
Yeah, it had a good day today. So it was up probably the most of those names today. It's given a little bit back. We've been saying forever, and tomorrow when Bob Iger's on the air, ESPN is nice. It's a nice issue to solve. But the bigger question is streaming profitability. And this definitely helps the linear business, the path forward. But the profit margins on Disney Plus and Hulu to us are the real driver of future value. So I'm not reading too much into what happens after the market. They had a good day. But tomorrow, the focus is going to be on long-term profitability for streaming. That's what we're focused on.
Okay. So I got to ask you about Snap. Huge move after hours, down double digits right now, stronger than expected results, except for guidance around EBITDA and profitability, which seems to be the real pressure point here. Are you surprised to see a move like this? What's your takeaway in terms of these results for this name?
Well, one takeaway is that, like a broken record, Snap always drops. Snap trades up after earnings and then drops when people see the next set of earnings. That's always been the case. But to us, the problem with Snap is I don't think they're ever going to make any money, true GAAP profitability, because they have massive stock-based compensation. So I think the market's moving on to real cash flow and real earnings. And as you saw with Meta last week and all the other big tech stocks, they generate a ton of free cash flow. These guys are barely scraping by. So I think it's about long-term profitability, and the valuation is just insane. We have an $8 price target, and stock just keeps running after earnings, but at some point it'll come back to reality.